Hi everyone, it is Monday the 29th of January and that means it's time to take a look at what moved the markets last week. I wanted to spend the time today focusing on stocks, so I'm just going to breeze over the macro data that became public last week. The big ticket items, most certainly being GDP for the US, coming in significantly stronger than was expected. The US economy is still doing very, very well. And in addition to this, we've got the core PCE numbers, which, as I mention every time I talk about them, is the Fed's preferred measure of inflation. And the month-on-month number came in as expected, whereas the year-on-year number came in lighter than expected. So it looks as though inflation is under control and the US economy is still doing okay. The case for a soft landing keeps on getting stronger. Now, last week, that being the week of the 22nd, we saw many very interesting earnings reports hit the market. I don't own stock in all these companies, but I tend to follow businesses that can be bellwethers for their particular areas of the market, their industries or sectors. First amongst these was Netflix. Netflix did very, very well through their financial year 2023. They hit double-digit revenue growth for the first time in a few years. They also grew their operating margin, and as I expected, Netflix is doing very well. I think it's highly unlikely that this is a company that's going to return to the kind of growth that we saw through the 2010s as an example, but it does look as though it's maturing into a business that's capable of continuing to grow at a reasonable clip. What I also find quite interesting is their attempt to enter the gaming market, and it's difficult to read when I highlight it here, but it's this paragraph on screen. Their engagement tripled through the last year. So their initial forays into gaming were awful. The games that they had were completely terrible. But if you've taken a recent look at the catalog of games that they have available, it is quite incredible. They've got some really, really good names in there. On top of this, and I'm not sure how many of you have followed it, but Apple will now have to allow people to install apps from third-party app stores. This is because of the Digital Markets Act, which lands in the EU in March. And I think that this could be a good opportunity for the likes of Netflix and maybe a few other well-positioned players to start creating app stores within the EU. Netflix's stock price jumped quite nicely on the news. You can see there was quite a nice bump there. And I also wanted to zoom out for a moment just to get a bit of perspective. It was just 2 years ago at the end of 2021 that we saw the Netflix share price drop by nearly 75%. Still got some ways to go to achieve the all-time high that it set back then. But I like to look at charts like this to remind myself that the stock market can rarely overreact. By the way, this is not the first time that Netflix saw such a huge drawdown in their stock price. It happens every few years. This is why I find it so important to know what you own, and sometimes you're going to have to hang on for a while in order to achieve outsized gains. The second company I wanted to talk about is Tesla. I don't own stock at the moment in Tesla. I haven't owned stock in the company for a few years. There's a lot of information to digest in the earnings report, but the long and short of it is that sales have slowed down. They've had to drop prices, which has meant that margins have been compressed. They're less profitable. And while they do see another growth catalyst in the future, the next-gen model platform, looks as though that this is probably a year or so out. The market absolutely hated this message, and you can see that the stock price fell off a cliff. And if we look at the year-to-date share price for Tesla, we can see that just in the 1 month of this year, the price is down nearly 25%. I don't talk about Tesla very much, but I do admire the company. There have been periods when the share price has been very, very cheap. That hasn't happened for a long time, and times when the share price has become incredibly expensive. Times are incredibly tough right now for the likes of automakers because just like real estate companies, they rely on the interest rate not being too high because people usually have to take out loans in order to buy houses and cars and other big things. However, I still believe that in the West, Tesla is the market leader for EVs by quite a long way. This has been cemented by the fact that many companies that have made automobiles for a long, long time, decades, are suddenly making statements, negative statements, about the future of EVs or dialing back their ambitions when it comes to electric vehicles. I don't know for certain, but I imagine that if you are an internal combustion engine car maker, it's very difficult to build both ICE vehicles and EV vehicles in parallel. You need factories, people, suppliers, with slight variations on all the bits and pieces you need to make those vehicles. And you don't just want to abandon all of your ICE infrastructure because a huge amount of money has gone into building that out. So I believe we're at this weird tipping point for these companies that are building both EVs and ICE vehicles. At some point, they're going to have to let go of the legacy ICE component of their businesses. And that's going to be very complicated and potentially very expensive. Whereas companies like Tesla and in China, BYD, they don't have this problem. They're able to focus on one particular kind of automobile and pour everything they have into it. So for the first time in a long time, I am watching Tesla stock quite closely and considering opening a position, although I probably wanted to fall a little bit further from current levels. The third company I wanted to talk about is Freeport-McMoRan. This is a business that I have been building a position in slowly. It's still quite small at the moment. FCX is in the top 3 copper producers in the world. Their share price has had a tough time through the past year or two, and that's because the price of copper is very tightly bound to the economic cycle. So when economic growth falls, the price of copper falls, and of course that has a direct impact on companies like FCX. Despite this, they put out an incredible earnings beat last week. They are a very well-run company. And although I think global economic growth is only going to really kick in next year, I do want to start getting in FCX at current prices. I think that the potential upside here is twofold. It's not just a recovery of the market, but also the fact that demand for copper around the world is growing. The electrification of our world is something that has been going on in the developed world for some time, but in many developed nations is something that's only recently kicked off and has still got a lot of runway when it comes to growth. The next two companies I want to talk about, Visa and American Express, are companies that I like to keep an eye on because they give you insight into whether people are still spending or not. If we just have a quick look at Visa, for example, we can see that it beat both on earnings and sales, and that revenues were up 9% year on year, driven by growth in payments volume. Having a quick look at the headline items when it comes to American Express, we're seeing a similar story, although here you can see that we are looking at double-digit growth. But if you dig into the details of the earnings reports, you will also see that there just are more things being bought. The key takeaway here is that despite the high interest rates, people are still spending money. The final business that I wanted to look at is Intel, just because I'm curious. Through the lockdowns and pandemic, we had an incredible shortage of semiconductors. This highlighted just how fragile the global system was when it came to semiconductor suppliers. The result of this was that countries like the US started setting aside many billions of dollars to pour into building out these kinds of capabilities domestically. Intel is a company that once was a forerunner when it came to semiconductor production, but have fallen well behind other companies like Taiwan Semiconductor. What we learned from Intel's earnings was that for the quarter just gone, the numbers were okay, but their forecasts are very soft. This is a very bad sign for them because right now, many other companies involved in semiconductor manufacturing and design are completely knocking it out of the park because AI is creating such a huge spike in demand. There were a few bright spots in Intel's earnings. However, it is very clear that Intel is years away from becoming a true competitor on the global stage. All right, let's shift our view and take a look at what's coming through this week. There is a huge amount of macro data that is hitting the market through this week, starting tomorrow. We've got GDP information out of certain geographies. We've got CPI information, PMI data coming out. We're also going to get the Fed's interest rate decision on Wednesday, as well as their statement. We'll then see the Bank of England's interest rate decision the following day on Thursday. And we'll get quite a few data points out of the US telling us how the labor market is doing. For example, jobless claims, non-farm payrolls, the average hourly earnings number, as well as the unemployment rate for January. So we have quite a lot that could create volatility in the market. However, I think that the largest impact we will see this week is going to come through earnings. A large part of the Magnificent Seven, for example, are reporting earnings, and many other businesses, Microsoft, Google, Amazon, Meta, Apple. If for some reason the lot of them had a terrible quarter or the lot of them had a great quarter, then I think we could see the market shift sharply in one direction or the other. All right, that's for this week. I hope you have a good one. Speak to you soon. Goodbye.